You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? This is Mike from The Moose on the Loose. How are you doing this Monday morning? I can tell you my level of energy is very high today, mostly because I had an amazing weekend, including the soccer game, the Montreal CF against Miami FC. Of course, the only thing we want to hear about is Lionel Messi there. I was there with my two boys. It was an amazing moment. We had a lot of fun, and I was kind of like surprised to see how Messi just manages energy just to pop out at the right time. But for the rest of the game, he's pretty much almost invisible. And then from time to time, there's a spark and he touches the ball and does something with it. So anyways, that was a lot of fun, a lot of hype. I was super happy to share that with my boys. But today we are talking about something else, but it's still a hype, which is kind of surprising, right? Last week, Canadian Tire, ticker CTC.A.TO. So you're better off with CTC.A.TO. There's also the ticker CTC.TO without the A, basically. But this one is more for management. So you have less volume, the dividend is different, and so on. So you want to buy CTC.A.TO if you are looking for the stock. So Canadian Tire reported their earnings last week, and on May 9th, the day that they reported their earnings, the stock went up by almost 6%. And it's still a big player in Canada, right? So market cap of 8 billion, it's not the end of the world, but it's a iconic brand in the retail space if you want to know what's going on with the Canadian economy. And when you see the stock going up by 6%, you might be thinking, oh, that means they made a lot of money, that should be great, and so on, and the quarter should be amazing. Well, the thing is, the financial markets, they are always thinking about the future. So when they see quarter after quarter, what happened for about a year now for Canadian Tire, that results are worse than expected or not that great. They're slowly, the sales are slowly declining. The earnings are slowly declining. Management saying, yeah, you know what? Consumers, they don't spend that much anymore. Well, of course that the stock will trend down. And this is what actually happened. So total return over the past 12 months, that is including almost a 5% yield dividend inside of the return, down by 10% over the past 12 months, including a 4.86% dividend yield. So almost 15% down just for the stock price over the past 12 months, while as a comparison, the TSX 60 is up 12%, including dividend as well. So up 12 versus down 10, especially because not too long ago it was down 20. Definitely the market didn't expect much from this quarter. And this is actually what happened is the numbers were better than expected, but they were not great. Revenue were down by 5%, 4.9% global revenue. And if you look at comparable revenue, so those are same store, it's down 1.6%. So a little bit better, but still not great. So Canadian Tire stores are down 0.6%. So roughly flat, basically. Marks were down 1.2, and then Sport Cheks were down 6.5, mostly because soft weather brought less people to buy skis and snowboarding equipment, and that is the explanation that management is given. On the upside, though, earnings per share went from 38 cents to 1.38. There's a lot of adjustment including in that, though. I'm going to spare you the details because I only have 10 minutes. One thing that was positive, though, is they are finally lowering their inventory, meaning that they will probably stop making huge promotions, so they're going to sell at a better price. And the other thing is, due to a better price, a better product mix, so in other words, selling products with better margin, the margin increased by 193 bips. So roughly 2% up, so to 37.1%. So they paid less for their transportation, so lower freight rates and a better mix. That was the explanation. One thing that bugged me in that report, though, is when you look at the management comments, they were saying, yeah, it was a great quarter despite everything else. It's doing great. And even the financial services did okay. And I was like, oh, that's good because, Canadian Tire, they offer their own credit card. They offer you to they offer you to finance some of the purchases, so that should be quite interesting for them. It's a good way to make additional money. So on top of pushing the sales of their own products, they're also financing them, making money on the interest rate. Obviously, when the consumer is tightening up on his budget, you may think probably they're gonna have higher losses or impairments. So I thought when I read the comments from the CEO, I was like, oh, that's quite interesting, and probably it means that the financial services did well. So I went back a little bit lower in the details to see what happened there. And financial services, actually, revenue were up by 5%, 5.2% up. So I thought, okay, so they're not lying because, the CEO literally said, and at the beginning of the press release, our financial services business continued to perform well, driving profitability in the quarter. And then let's take a look at the profitability, right? So yes, they didn't lose money, but the profit is down 19% versus last year. So yes, they drove profit. It's not like a losing business segment, but how can you say that it performed well? You're down 19%. I'm not too sure it's great, right? And then when you look at why they're down 19% on their profit, well, you probably guessed it by now. Higher impairment charges, net charges losses. So in other words, they're losing. There's some consumers are not paying, so they're losing money on some credit cards, and that's why they made less profit. So yes, it is a profitable business, so that's great. But on the other side, being down 19%, you cannot exactly saying that it's a thriving business, and for the future it may be an indicator that the upcoming quarters are not going to be rosy for that business segment. So overall, what is my take from Canadian Tire from this quarter? Quickly, well, first, no surprise here. I did not expect revenue to go up. I actually expected to keep up going down slightly for the next quarters. It's going to be the rest of the year will be the same story. Consumers are tight, they're not spending much, and when they do, they buy more essential stuff than luxuries or any treats that they could have. So long story short, they still go to Canadian Tire, but they're not going to spend as much as they used to. Second thing is, of course, because of that, earnings are going to take a hit. And this is exactly what's happening. This quarter, it's a little bit better, but going forward, do not expect huge earnings per share to grow. It's just normal. It totally makes sense. And when you're considering that, yes, the earnings per share was $1.38, but the dividend is $1.75. Which is not exactly leading to a great payout ratio. Keep in mind, Canadian Tire is a consumer discretionary company. They're going to do well when the economy is doing well, when there's plenty of jobs, and then when consumers spend a lot of money. Right now, we are still good for the unemployment rate. That's relatively stable, but consumers are spending more money on their mortgage right now than anything else. Price of gasoline has increased as well. So transportation, household are the main budget, the main budget eater for consumers. So they're not likely going to go to Canadian Tire that much, and that will continue going forward in the next quarter. So I don't expect much from this company in 24. I think it could be a pretty interesting opportunity, though. If you are patient enough and if you do your due diligence, this could be an interesting one. Of course, the yield starting to get a little bit higher to my taste at 4.86, almost 5%. Not a big fan of those kind of thing, but again, those cyclical stocks, they go up, they go down, and when they go down, it's time to be courageous, to do your due diligence and verify if it's a good stock to be in your portfolio. And for the next time that the economy is going to boom, of course, this is the type of business that will be well positioned. So keep that in mind, but keep also that in mind that over the past 10 years, Canadian Tire has underperformed the TSX. So most of the time it's slightly following it, but over the past 2 years, it has been on down slope since the peak of 2023. And this is how the investment game is playing, right? All right, Moose, that's enough for today. I hope that you have enjoyed this podcast as usual. If you do and you did not give me a rating yet, please take a second to go on Spotify, on Spotify or on Apple Podcasts, just to click on the ratings, give me that 5-star. It's going well. We have like over 200 reviews now, so I thank you for that. And yeah, so that helps to share this podcast with anybody else. And that's it. So all right, Moose, take good care. We're going to talk again tomorrow. And until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.